Hi again. So far, we've covered an awful lot of information in this DVD series. We've talked about technical analysis. We've showed you some of my favorite chart patterns. We've talked about bullish setups that allow you to profit using call options or uncovered puts. We've talked about bearish setups that allow you to profit off the downside in a stock move. And I hope you've been able to use some of that information to achieve excess portfolio returns, things that you haven't been able to do before. And as exciting as all that information has been, I think today's going to be the best. I think this particular DVD is going to cover more information and show you even better how to consistently profit in the options market. Things we're going to talk about today are seemingly a little bit more complex strategies. Things like spreads, straddles, combination trades, things with a lot of syllables in the words. Don't let that throw you. Spend a little extra time with this particular DVD. This is going to be the one that takes you from a novice option trader to an expert option trader. That's why I'm so excited to share with you the information that we've got here today. You know, the last DVD we left off, I showed you a trade of the IYT, the Dow Jones Transportation iShares. And we talked about how it had a head and shoulders pattern developing and how it looked like it had a pretty good shot at another 5 points to the downside if that pattern broke. But remember, on that particular trade, we couldn't find an option that made any sense to purchase. So we threw the trade away and said, oh, we'll find something else. Well, today I'm going to show you there's something else that we can do. Let's take a look. Once again, we were talking about the IYT trade. We were looking at buying, possibly, the June 90 puts, which were trading for about $4. And just as a quick review, we were talking about buying the opportunity to sell IYT at $90 a share anytime between now and option expiration day in June. It was going to cost us 4 points. $400 for the right to sell 100 shares of IYT at 90. And remember, our target for IYT was 85. Meaning, if the stock fell all the way to our target, we had the right to sell it at 90, we can go in the market right away and buy it for 85, that put option would be worth 5. Problem was, we had to pay $4 to get into that trade. So we were risking $4 to have the opportunity to turn it into 5. We were risking $4 to make 1. In the option market, that's a stupid trade. So if you remember way back early in the series, we talked about how 2/3 of the time, roughly about 2/3 of the time, most people are going to lose money trading options. So on that 1/3 of the time, you have to be able to profit enough to make up for whatever losses you incur on the other trades. Making $1, or roughly 20% in an option trade, isn't going to do it. Let me show you how you can turn this into a profitable trade. In fact, if you remember just one thing at all out of anything we've talked about in the entire option series, I want you to remember about spreads. Spreads are BS. Not that kind of BS. Spreads are a buy and a sell. Let me explain this. We don't like this trade by itself because this option is too expensive given our objective for the stock. If this option is too expensive, there's a pretty good chance every other option that's related to IYT is going to be fairly expensive. To block this out, I'll give you the idea here. The June 85 puts are trading around 2.5. In other words, the right to sell IYT at $85 a share costs you $250. The right to sell 100 shares of IYT at 85. Now, we weren't even considering buying those because our target was 85. But think about this. If you like the idea of IYT falling, you think the stock has a pretty good shot of breaking all the way down to 85, why not buy the right to sell the stock at 90 and then sell to somebody else the right to sell the stock to you at 85. One more time. You're going to buy the right to sell the stock at 90, and if you sell the 85 puts, you are going to obligate yourself to buy the stock at 85. That's a buy of an option and a sell of a different option. We're buying an expensive option, and we're selling an expensive option. The way that that works out is up here. We've bought this one, and we've sold this one. We're spending $400 over here. We're collecting $250 over here. So on a net-net basis, we're into this trade for $150. We have the right to sell the stock at 90, and we are now obligated to buy the stock at 85. The most we can possibly lose on this trade is $150. We have the right to sell the stock at 90, obligated to buy it at 85, paid $400 for the purchase, to purchase the option, received $250 to sell the option. We're into the trade for $150. If the trade goes against us, if IYT goes straight up to the moon, we're going to lose 150 bucks. IYT drops, however. Let's say it hits our downside target of $85 a share. Look at what happens. Remember the first example, we were just buying the puts. 90 puts, stock drops to 85, this option's worth 5. We'd have made 1 point on a $4 investment. However, by creating a spread, by buying one option and selling the other, we've reduced the amount of money we've had to put up. Instead of putting up $400, we're putting up $150. We've reduced our risk. We were risking $400, we're now just risking $150. And if the stock drops to 85, think about this for a second. At $85 a share, the June 90 put is going to be worth 5. The June 85 put, what's that worth? If the stock is trading in the market at 85, somebody has the right to sell the stock at 85. On June option expiration, there's no time left. There's no value to that option. This option expires worthless. So we're able to close the position out, in other words, sell this put option, let this one expire, and receive $500 for selling this put option. Look at the math. We put $150 into the trade. We're able to close it out and take $500 out of the trade. So a position that we weren't going to use before, a trade we weren't going to take because this option was too expensive, is now a trade where we've made more than 200% on. We're into the position for $150 instead of $400, and we can sell it for $5. That's a $350 profit, 233% return on a trade that we were going to throw away, all because we were able to create a spread. So let me give you another one. Take a look at your screen. You see we have a chart of everybody's favorite stock, Apple Computer. And how can you not love this stock? It's one of the best performing stocks in the market the past few years. They have everything, iPhones, iPads, iMacs, everything to do with Apple's got it. Wonderful revenue generation, wonderful fundamentals, everything looks wonderful with the stock, except I'm looking at the pattern, I'm thinking, this looks like an attractive short sale. Let me explain why. You can see what we've drawn out there, the support and resistance lines over the past couple of months. You have sort of a triangle forming sideways. Now what we've talked about so far, we've talked about rising wedges, we've talked about falling wedges. This is sort of a sideways wedge. We call it a consolidating triangle pattern. And it's basically a situation where you have higher lows and lower highs. So the stock very slowly starts to contract and come together. And of course, it's like every other wedge, every other triangle, it's going to reach an apex and it's going to reach a decision point where that stock has to break out or break down. If it breaks out to the upside, we can look forward to a pretty strong move. Breaks out to the downside, we can look forward to a very strong move. So the trick, obviously, is trying to figure out which way is it going to break. For clues on that, we've got a reliable MACD indicator. Remember, MACD is the moving average convergence divergence indicator. Remember what I said about that? It's a momentum indicator. It tells you basically how strong or how weak the momentum of the trend is. In Apple's situation, Apple's been in an uptrend for quite some time. But notice how, ever since about October of last year, the MACD has been falling. So the stock has been rallying while the momentum has been falling. That's negative divergence. That's a caution sign. It's a sign that says maybe the trend's about to end. Maybe we're about to get a reversal. And as a trader, what we're looking for on this is some place where we can take a low-risk position to bet on the downside for Apple. Well, your low-risk position is going to come as you get closer and closer to the apex of that consolidating triangle. Now take a look at the stock. Stock's currently trading around $350 a share. If you look at the distance between the support and resistance lines at the beginning of the triangle, in other words, the support line at the beginning of the triangle is somewhere around mid-January, and the resistance line for that triangle is forming somewhere around middle of February. And the distance between the high and the low there, let's see, the high's around $360 a share, the low's around $330, so you've got about a 30-point swing. So when this stock finally does break out of the pattern, we can expect it to move 30 points upside or 30 points to the downside. My bet, given the MACD, is this is going to break to the downside. So we've got to take a look at options. take a look at put options for this. Now, again, whenever you break out of a triangle, the move tends to be fairly quick, fairly violent. So we're looking for a potential 30-point move to the downside. There's no reason to go too far out in time, so we might look at buying the Apple June 350 put. Currently priced at around $25 a contract. When I say 25, that's $25 per share. In other words, $2,500 for the right to sell 100 shares of Apple at $350 a share anytime between now and option expiration day in June. Now we're talking about a 30-point move. So we're looking on the downside of this, we're looking for Apple to finally wind up somewhere around $320 a share. We're buying the right to sell it at 50. If it reaches our downside objective of 320, we have the right to sell it at 350, it's trading around 320, go in the market and buy it at that, we have a 30-point swing. So that option should be worth, with no time left on option expiration, that option's going to be worth 30. But we paid 25 for it. So we put up $2,500, and when we close the trade out, if everything goes right, if everything goes our way, and Apple does exactly what we think it's going to do and hits our downside target, we'll be able to sell it for $3,000. So we've put up $2,500, and we have the opportunity to make $500. Gosh, that's exciting. That's sarcasm. It's not exciting. That's a horrible trade. $500 on a $2,500 investment is nothing. Again, if you're going to lose more often than you're going to win trading options, then you need to have some sort of a strategy that allows you to make more money on the trades you win than what you lose on the trades you lose. Making 20% on a trade isn't going to do it. So we need to find some other way to do it. So I say BS, a buy and a sell. That's a spread trade. We're going to buy the Apple June 350 put, and we're going to sell some other put. Because if the Apple June 350 put is expensive, odds are pretty good every other option on Apple is expensive as well. So here's what we'd put together. Let's buy the 350 put at 25, and we'll sell the 320 put at 13. Now look at what we've done here. We have the right to sell Apple at $350 a share anytime between now and option expiration date, June, and we've put up $2,500 for that right. We're selling a put, so we are obligated to buy Apple at $320 a share anytime between now and option expiration date in June, and for that we've collected $1,300. So we spent $2,500. We're collecting $1,300. We're net into the trade for $1,200. That's our risk. Now look at this. Instead of just buying the put, putting up $2,500, in that case we'd have $2,500 worth of risk because if Apple turns around and goes higher, we could wipe out on that position. By selling the other put, we've reduced the amount that we have invested in the trade. We've lowered our risk. We've lowered our capital intake into that position. Lowering risk is always a good thing. So spreads always help to lower risk. And given the fact that our downside expectation for Apple is $320 a share, this makes sense. We have the right to sell it at $350. We're obligated to buy it at $320, which is where we think the stock is headed anyway. So if this actually happens, if Apple in fact does fall to $320 a share, we own the right to sell the stock at $350. The stock's trading at $320. The value of that right to sell it at $350 is going to be the difference, or $30. We're into this position for $1,200. We'd be able to sell that part of the spread for a total of $30, or $3,000. At $320 a share, that put is worthless. The 320 put, the obligation to buy the stock at 320 expires worthless when Apple is at 320 per share. We don't have to do anything with that. So we would be able to close out this position and collect a total of $3,000. We spent $1,200, we received $3,000 to close it out, we profit $1,800. So we've taken a trade where if you just bought the put, you can only make 20%. We've turned that into a trade where, first off, we reduced our risk, cut our risk in half, in fact. Instead of risking $2,500, we're only risking $1,200. And we've increased our profit potential. Instead of just making 500 or 20% on the position, we can make 1,800. That's 150% on this particular trade. So we put less capital at risk and we have the potential to make even more money. If Apple drops to 0, yeah, we would have been better just having the 350 put, just owning that. But we don't think Apple's going to 0. We think Apple's going to 320. So based on where our potential targets are and what we're looking for as far as the objectives for the trade are, this makes a whole lot more sense than just simply buying the put. Let me show you another one just to make sure it all works out clearly. See, I love this trade. Take a look at your screen and you see a chart of Netflix. I don't know why, but in the back of my head, I just keep thinking Netflix has to be the absolute no-brainer short sale. Of course, I've been thinking that for a while, and had I actually traded it, be underwater on every single one of those thoughts. Lots of folks think Netflix is a short sale. Lots of folks think it's way overpriced, and they're probably right, but lots of folks are taking a bath on that trade. Some of the biggest hedge fund names out there on Wall Street have been short this stock, and they've been short the stock for a long time and from a much lower price, and they're sitting on huge, huge losses. Again, that's one of the problems when you're trying to short a stock that has a lot of momentum behind it. So you really have to wait for some sort of technical breakdown or some sort of momentum breakdown that allows you to make this trade. And I keep looking at this chart of Netflix and I think, gosh, you know, if I could just fall asleep for 6 months or a year, if I could put a trade on and not look at it again from a year, I'm pretty sure this stock is lower. There's no guarantees in life. But when you've got a stock that's had such a run and it's so overvalued relative to any other fundamental metric, gosh, it seems like a no-brainer type of a trade. But there's risk in doing something like that. Nonetheless, let's take a shot at it and see what happens. Take a look at Netflix, and you can see the support and resistance lines drawn in. This is a beautiful, absolutely beautiful rising channel pattern. You want to own a stock like this. You're crazy to short a stock like this until it actually breaks down from its rising channel. And you'll see at the very tail end of this chart, starting the beginning of March, you see that in fact Netflix did break just a touch below the support line of its rising channel. Came down a little bit and since has come back up and is now testing that rising support line from below. Now remember from a couple of DVDs ago we talked about how when you break down below a support line, that support is now resistance. When the stock comes back up to test it again, it ought to hold below that price level. Think of those support and resistance lines kind of like metal bars. If you break below it, when it comes back up, it's going to bang into it. It's going to have a little bit more difficult time getting over it. Now, it's all relative. I mean, sometimes you can blast right through. Sometimes it serves as resistance. Not everything works perfectly all the time. More often than not, though, that line's going to serve as resistance. So this is an ideal time at which to put on a short position. Taking a look at Netflix options, though, they're pretty expensive. Like I said, if I could put on a position and not look at it again for a year or even 2 years, I think this would be a wonderful stock to short. So just for fun, let's take a look at some of the option positions on this. Going out to January of 2013, that's a long time. Anytime I'm trading options, I usually keep it a little bit tighter, a little bit shorter term, but in this case, since you have such a fundamentally overvalued stock, maybe it takes that long to work out. But the January 2013, 200 puts are currently priced around 50. Now, this is an outrageous premium. The stock is around $220 a share. We're buying the right to sell the stock at 20, 10% below where it is right now. Stock's at 220, we're buying the right to sell it at 200, and it costs us 50 points to do that. $5,000 for the right to sell 100 shares of Netflix at $200 a share all the way up to January of 2013. Now, yeah, we're buying a lot of time. I mean, good grief, it's almost 2 years. But it's costing us a fortune to do that. Our break even on this trade, in order for us to get this $50 back, Netflix has to fall to $150 a share. It's at $220 now. So we're looking for, I don't know, what does that work out to? About a 30% drop in Netflix in order to just break even on the put option trade. That's an expensive option. It's not a trade I would typically do, except for the fact that you can always create a spread trade out of this. Now think about it. If this is an expensive option, every other Netflix option is going to be fairly expensive. And in fact, that's the case. Look at the price of these things. If I punch up real quick here, the Netflix 150 puts cost around $30. So I'm buying this one. So what I'll do is sell the January 2013 150 puts at about 30. So look at what we're doing here. We have the right to sell Netflix at $200 a share anytime between now and January expiration in 2013. And for that right, we've paid 50 points, $5,000 for the right to sell the stock at 200. And we're selling to somebody else the right to sell the stock to us. We're obligating ourselves to buy the stock at $150 a share, and for that obligation, we're receiving $3,000. So we spend $5,000, we collect $3,000, we're into this trade for a total of $2,000. Here we have the right to sell the stock at $200 a share, and by selling the January 2013 150 put, we're obligated to buy the stock at $150 a share. Let's say we're Rip Van Winkle, we fall asleep, we wake up January 2013, and the stock is at 150, or maybe it's even below 150. At 150, that's our maximum profit anyway, because remember, we've agreed to buy the stock at 150. We can sell it for 200, but since we've agreed to buy it for 150, it doesn't matter if the stock goes below that. If it drops to 0, we're still not going to make any more money than if the stock just drops to 150. So we could technically go into the market, sell the stock for $200 a share, be obligated to buy it for 150, close that entire trade out for 50 points. It cost us 20 to begin with. We spent $2,000 on the trade. We close it out, we collect $5,000, and we've profited $3,000 on the trade, or roughly exactly 150%. So we've taken a trade that used to have an outrageous premium. There's no reason to take this trade, to buy Netflix, unless you think the stock could be in the $50, $60, $70 range. Then it might make sense, because then at least you could double your money if you just simply bought the January 2013 200 puts. But that's a lot to ask. Even though the stock is in the stratosphere, even though the potential is there fundamentally for it to be trading much lower, still not a trade I would take on. It just seems too much of a challenge to drop that far. But by selling another expensive option against the option we purchased, we're able to reduce our cost, reduce our risk, and increase the potential for profit. Understand, if all you've done is bought a put, you need that stock to drop all the way to 150 in order for you just to break even. By reducing the amount of money that we've put into the trade, we've reduced our cost basis, and we've created a situation where the stock doesn't have to fall quite so far for us to break even. In fact, think about it. We're only into the position for 20 points. We only need the stock to fall 20 points below our put strike price in order to break even on the trade. So instead of breaking even at 150 by just owning the puts, by putting this trade together, by putting this spread together, we've created a situation where we can break even at 180 on the stock. That's a big, big difference. We start profiting as soon as that stock falls below 180, as opposed to waiting for it to fall below 150. So you can see what I talk about when I say spreads are very valuable trades. Most people don't do it because they can get a little bit complex. I mean, there's a few more numbers involved. There's a few more calculations you have to make. You have to spend a little bit more time in order to work out the strategy. But believe me, it's worth it. In every situation, when you work out a spread, when you're buying an option, selling another, you're always going to have a situation where you can reduce your risk and increase your profit potential. Now, obviously, you do it when you think you have a pretty good price target on where you think that stock ought to go. And if you're using option positions based on technical analysis, based on all the charts that we've talked about, that's exactly what we have. We have positions where we're able to say, I think, relative to what has happened in the past, relative to past price and volume action on the stock, we can project where that ought to go in the future. We can set a price target, we can create an option strategy, whether it's a straight call purchase, call sale, put sale, or some form of a spread. We can create some sort of a strategy to give us the maximum profit. That's what we've tried to do here. Now, next I'm going to show you about synthetic trades. Synthetic trades add one more element to this. So yeah, it gets a little bit more complicated, but heck, this is on a DVD. You can play it over and over and over and over again. The best thing about synthetic trades, though, is you actually get paid to put the trade on. Not kidding. You actually get paid. You make money right away as soon as you put the trade on, and in many cases, it's really not possible to lose money. And we'll talk about that right now. All right, so we'll take a look at a synthetic trade. Now, synthetic trades, be perfectly honest, these are my favorite. Absolute, no doubt about it, my absolute favorite trades. They're a little bit more complex than some of the stuff we talked about already, but these are the sorts of trades that you live for. You could be wrong on the trade and make money. And I'm not kidding about this. You can be right on the trade, be moderately right on the trade, or be absolutely dead wrong on the trade and still profit off of it as long as you get the setup correct. Now, the term synthetic means that it's something like the original. It's not exactly trading stocks, but it's like trading stocks. So when we put this position together, the entire position itself is going to trade very similarly to how the actual underlying stock trades. In other words, if you put up a synthetic trade on Apple Computer, the synthetic trade ought to behave very similar to how Apple Computer stock trades. You put up a synthetic trade on the Dow Jones iShares Transportation ETF, the synthetic trade ought to trade just like IYT trades. So all of those things go together. But because you are collecting money up front most of the time in these types of trades, you create a situation where you have a little bit of leeway to be wrong. You can be absolutely 100% wrong in the trade and still make money. Let me show you one. Take a look on your screen there and you see the ProShares Ultra Short Lehman 20+ year Treasury ETF. Long word, we call it TBT. Basically, it's an inverse bond exchange traded fund. In other words, if you think the prices of bonds are going to fall, this is the kind of stock that you buy. If you think interest rates are going to go up, this is the kind of stock that you buy. And if we talk about Rip Van Winkle trades, this is perfect. There are some things that you just know are going to happen, right? You know the price of gold is going to go higher given the economic condition. You don't know when it's going to happen, you don't know exactly how it's going to happen, you don't know the trigger point to it, but you got a pretty good understanding that gold is going to go higher. By the way, when I say you know that's going to happen, that's my interpretation of it. It's not a guarantee, but that's what I think should happen. Interest rates is sort of the same thing. Right now, interest rates in the United States of America are historically low. We're looking at, gosh, you can get a 30-year mortgage for 4.5%. When before have you been able to do that? And when before have you been able to do that when you have inflation rising at the rate that it is? It's just insanely low. And part of that has something to do with the fact that the Federal Reserve Board is keeping interest rates low in order to stimulate the economy. It's the whole quantitative easing sort of thing. Now, as a result of that, bond prices have ratcheted higher. You've got the Treasury market. You've got buyers jumping in there to buy interest rates and lock up as high a yield as they can possibly get for as long as they can. And you have the Fed going in there with excess cash and buying up Treasury bonds, therefore creating a situation where the price of bonds go up, interest rates fall. Now, you know that situation can't last forever. It doesn't. Interest rates fluctuate just like everything else, and what we've seen over the past few years is a consistent drop in the rate of interest. At least that was the case up until September of 2010. In September of 2010, interest rates seem to have hit their bottom, and they've ratcheted up ever since. TBT is basically the inverse bond fund for the 20-year Lehman Treasury Index. In other words, Lehman takes a look at 20-year bonds, creates an index for it, and the price of that index as it moves around, TBT trades the opposite. It's an inverse fund. So if bond prices go up, TBT falls. Bond prices go down, TBT goes up. And if you're trading interest rates, if you're thinking interest rates are going to go higher, that means you think bond prices are going to go lower. I happen to think interest rates are going higher. I think they'll go much higher. But they don't have to go a whole lot higher to make money on the particular trade I'm going to show you today. Take a look at the chart again. You see, this is TBT, and TBT, first part of the chart, you see a declining channel. That's nothing new. We've seen those before. Then you see a slow period of consolidation somewhere between roughly August and November of 2010. You've got a consolidation phase, a low-level consolidation. That's where it was building up energy for the next move. And you see, as soon as it broke above roughly about $33 a share, it made its next move higher. You can see the rising channel develop. You can see how the stock pushed up. Now we have a situation where, for the past few months, TBT has traded between roughly about $37 a share on the downside and $40-ish, $41 a share on the upside. So we've entered a high-level consolidation phase. high-level consolidation phase, when TBT breaks out of that phase, it's going to make a decent move. Right now, it's been consolidating for about 4 months on this chart. So as long as it stays in that consolidation pattern, we can expect when it finally does break out of that pattern, it will at least run for about 4 months. So we'd be looking at trading options 4 months into the future. So there's a couple of ways you could trade this. You could, looking at this chart, you can see how right now, TBT is trading around $37 a share, and you see that is a support line. We've drawn that in on the chart. If you like what I'm saying, if you like the fact that maybe TBT goes higher from here, this is a good spot at which to sell put options on it. Sell uncovered puts, obligate yourself to buy TBT at $37 a share. We've gone over how to do that. Should be old hat to you by now. Another thing you can do here is simply wait until the stock breaks to the upside, meaning it breaks above $40 a share, and you buy call options on it. And you can trade it that way, trade the upside breakout on it. Now, since I happen to think interest rates are going higher over the long term, I like the idea of a Rip Van Winkle trade. In other words, something you can put on today and you can go to sleep and hold on to it for a while, and then when you wake up, all of a sudden you find out you made a ton of money. Let me show you what I'm talking about. Now remember again, the purpose of a synthetic trade, the purpose of a Rip Van Winkle trade is you've got a stock that you are relatively convinced is going in some direction. You know at some point this is going to happen to this stock. And you want to place a trade where you can profit off of that without having to worry about it all the time. You can put the trade on now, fall asleep, wake up, and son of a gun, there it goes. It worked out perfectly for you. But you don't want to have a ton of risk if it goes the other way. Now with TBT, which is my favorite example of a Rip Van Winkle trade, you could just simply buy the stock here at $37 a share. Sure, why not? Buy it at $37. If it goes up, you make money. Simple enough. Of course, if it doesn't go up, if it stays exactly where it is, you didn't make any money, and the entire time you were sleeping, you did nothing more than get a good nap. And if it falls in value, well, you lose money dollar for dollar along with the stock price. Well, how about put a trade together where you can make money if it goes up, you can make money if it stays the same, and you can even make money if the stock falls. That seems to be the best of all worlds. Now, what I'm about to show you, like I said, it's going to sound a little complicated at first. But as I've said before, repeat this DVD over and over and over until you get it, because this is one of the most powerful trades you can put in your trading tool. I'm going to throw some numbers up here. I'm going to give you actual prices of the options and show you how we put it together. Right now, TBT is trading around $37 a share. Right now, the January 2012 37 call options are trading for about $4.30. Right now, the January 2012 40 call options are trading around $3.30. Now, if you're following along, what you can tell here right away is we have the makings of a potential spread trade here. We have a situation where we could buy the January 37 calls, have the right to buy the stock at $37 a share anytime between now and option expiration in January 2012, and it costs us $4.30. All scrunched together, but that's $4.30. And we have the potential where we can sell to somebody else the right to buy the stock from us at $40 a share. And for that, we'd pick up $3.30 a contract. So think about that. We spend $4.30. We collect $3.30. Our net cost of this trade is just $1. So we have the right to buy TBT at 37, and we're obligated to sell it at 40. For that, we're out of pocket $1. $100 for the right to do that on 100 shares. If TBT goes up, it gets above $40 a share, we stop making money because we profit all the way up to 40. At that point, somebody else has the right to buy the stock from us at that price. So the highest we can go on this is up to $40 a share. Above 40, we don't make any money. What do you care? You put $100 in, at $40 a share, when you unwind this trade, you're going to unwind it for the value of the 37 calls relative to the 40s. In other words, when the stock's at $40 a share, the 37 calls, stock's at 40, you have the right to buy it at 37, 37 calls are going to be worth 3. If the stock's at 40 and somebody else has the right to buy it at 40, there's no value there. So it doesn't cost you anything to unwind that part of it. So you bought the position, you put it on for a total net debit of $100 per position per contract. You'll unwind it for $300 per position. It's a 200% gain on your money between now and January 2012, and all you did was fall asleep. Now, the best part about this, though, is if you're really convinced that TBT can go higher from here, really convinced that the economic situation in the United States justifies higher interest rates. Bond prices have to fall in that situation. Interest rates are going higher. TBT has to go up. It makes sense. It's fundamentally correct. It must happen. If you're convinced of that, then why not add a little bit to this position? Why not, on top of all this, sell a put? So we'll sell a TBT January 34 put. Those are currently going for about $1.50. $2.50, excuse me. They're going for about $2.50. Now look what we're doing here. On top of the spread trade that we did, all we did was add an uncovered put. Remember what you do when you sell uncovered puts. You sell uncovered puts on stocks you want to own anyway at prices you're willing to buy them at. If all we did was take a look at the uncovered put part of this position, we're selling the TBT January 34 put at $2.50. We're collecting $250 and we are obligated to buy TBT at 34. We like that idea. We like TBT at 37. Of course, I'm going to love buying it at 34. Why not get paid to be obligated to do that? So we have the bullish spread position, and now we have the bullish uncovered put. When you all add everything up here, cost you $4.30. You received $3.30, so you're out of pocket so far $1. Now you're going to receive $2.50 net into your pocket. You get a net credit of $150 to put this trade on. You put this trade on today, you get paid $150 to do that. You make money if TBT goes up. Stock's at 37, everything above 37 you make money on until the stock gets to 40. You make money if the stock stays at 37. At $37 a share, all of these options expire worthless on expiration day in January. You've collected your $150. You don't have to do anything. You've already made your $150. You make money if TBT falls. It's currently at 37. You're not obligated to do anything until TBT drops below $34 a share. And in fact, since you already picked up $150, TBT can fall 1.5 points below $34 a share before you start to lose money. So you'll make money on this position as long as TBT is anywhere above $32.50 a share. On January, expiration 2012. $32.50 a share on up is how you make money on TBT in this synthetic trade. Stock's at 37. You make money if the stock goes up. You make money if the stock stays the same. You make money if the stock goes down. As I mentioned, yeah, this is probably a little more complex. This takes a little more homework, takes a little more practice, a little more experience with the markets and able to put all this together. But don't just go through this DVD and say, oh gosh, that's too complex. I'll go back to just selling uncovered puts or just buying calls. All of that's fine too. But this is probably one of the most powerful trades you can put on. Because truly, if there's something that you have a strong conviction about, XYZ stock has to go higher. ABC stock has to go lower. TBT has to go higher. Anything you've got a strong conviction about that fundamentally has to occur over time, these synthetic sorts of positions help you profit on the upside with it, but they also give you a little bit of room to be wrong on the downside. Here again, stock's at 37, it can drop all the way to 32.5. We don't lose any money. So we can lose 15% in the stock, we're still doing okay on the trade. Now we've covered a lot in this DVD series. We've covered a ton in this DVD series. We've talked from everything about buying puts, buying calls, selling calls, putting spreads together, putting synthetic trades together, doing technical analysis, all this stuff. The great thing about it is you have it on a DVD format. So anything that's unclear or anything you want to review, you go back and do it. Take your time and do it. In fact, I think the smartest thing you can do right now is go through your existing portfolio. Take a look at your portfolio, take a look at charts on every position in your portfolio, and see if you can figure out where, in those 5 basic chart patterns that we talked about originally, where those stocks happen to be. Do you have a stock that's sitting there in a rising channel formation? Do you have a stock that's sitting there in a falling wedge formation? Do you have a stock that has strong MACD behind it? Do you have negative divergence? All of those sorts of things. You can take a look at your portfolio position and see how it plays out. There's a lot of information in this DVD set. Not going to pick it all at once, but take a look at your portfolio, see if you can pattern some of the things that we've talked about with what you're existing with today. Do a little bit of paper trading. Look at some option prices, see what would happen if I did this now, and watch how it trades over the coming days and weeks. Take a look at some of the philosophies that we've spelled out here. Try to incorporate them into your own portfolio trading. Bottom line, though, is have a good time doing it. See, option trading is not something that's designed to help you get rich quick. We've talked about this a lot. Option trading is designed to reduce the risk of your portfolio, and is designed to help add a little bit of pop to an otherwise conservatively constructed portfolio. Not that complicated. Where you make mistakes is when you take on too much risk. Where you make mistakes is when you over-leverage your trade. You don't make mistakes by taking things slowly. So take it at your own pace, relax, have a good time doing it, review this as often as you possibly can, and have fun in the trading world. It's a wonderful environment. I've been doing it for 28 years. I can't imagine not doing it ever again. I expect I'll be doing it for 28 years more and then more. So I hope you have at least a little bit of taste of the passion that I have for this, and I hope you can experience a little bit of that passion yourself. Thank you very much. Enjoy it.